welcome back to our channel. Today we're talking about the recent collapse of Silicon Valley Bank, the largest U.S. bank failure since the Great Recession. If you're worried about the health of the financial system, the stock market, and the housing market, stay tuned. We've got everything you need to know. Last Friday, Silicon Valley Bank, or SVB, officially failed and was taken over by U.S. regulators. SVB had built a robust business lending money to startups and companies backed by venture capital firms. And like many other banks, it kept most of its customers' deposits in traditionally safe investments like treasury bonds. But as the Federal Reserve began hiking interest rates in hopes of bringing down inflation, those investments lost a lot of their value. At the same time, declining economic conditions prompted many of SVB's customers to withdraw their money. SVB was forced to sell investments at a huge loss to meet those withdrawal requests, and that triggered a fear-induced scramble among other depositors, now worried about the health of the bank, to pull their money out. So how did the government respond? The Federal Deposit Insurance Corporation announced it would guarantee all deposits at both SVB and Signature Bank, which was also shut down by regulators as its depositors panicked. The FDIC went beyond its normal limit to prevent the crisis from worsening. Some pundits considered this a bailout, while others argued that, because the rescue money doesn't come directly from taxpayers and is intended for depositors, not big banks, it didn't technically qualify. Despite all the scary headlines, retail banking customers have good reason to feel confident about the safety of their money. The FDIC insures almost every U.S. bank, but you can check the agency's website or call to confirm that your bank is covered. FDIC insurance covers money in checking accounts, savings accounts, certificates of deposit, money market accounts, and more, up to $250,000 per account type, per depositor. So what do the bank failures mean for the economy? Experts agree that the turmoil in the banking world likely won't lead to a major economic disaster. But the recent chaos in the banking sector exposed some fragility in the economy right now. As the U.S. central bank works to bring down inflation by continuing to raise interest rates, it must be careful not to inflict too much damage on the economy in the process. Bank stocks plunged last week in the wake of SVB's collapse. Some have since recovered losses, but the stock market was still trending downwards a week later. Investors have been waiting for a sign the bull market is finally ending, and experts say they'll likely have to keep waiting. The turmoil in the banking sector has the potential to nip a nascent market recovery in the bud, strategists from Invesco wrote earlier this week. Finally, what will happen to mortgage rates? It won't just be investors watching the Federal Reserve's response to the banking crisis closely. Home buyers will be paying attention, too. Before SVB's collapse, the Fed had signaled that it would keep hiking interest rates, but this week's events could prompt it to change course. That could give home buyers a break in the form of lower mortgage rates. Falling rates on treasury bonds also foreshadow lower rates. This trend may provide some relief to prospective home buyers who have been facing skyrocketing home prices in recent years. However, it's important to remember that mortgage rates are influenced by a wide range of factors, and the full impact of the SVB collapse on rates is yet to be seen. Thanks for watching, and if you like this content, be sure to like and subscribe this video if you want to see more.